Hello, everyone, and welcome to today's podcast. I'm thrilled to be joined by our special guest, Arjun Paliwal, the founder and head of research at Investorkit. Arjun's accomplishments in this industry are unparalleled for his time in business, and as evidenced by his impressive achievement of winning the Real Estate Business Awards Buyers Agency of the Year, not once, but twice, 2023 and 2024, if you don't mind. Only Business Investorkit is to go back to back from what I believe, Arjun.
That's right. But I can't take all the credit for that, my friend. Our team is nearing 40 people now, and I take immense pride in the growth of the team, but the results is the team, not me.
Yeah.
Right. So I always talk about the growth of the team from a perspective of how important creating jobs is for me and helping more families is for me. But that whole back-to-back award is all the team. We've got some great people here that help families do a lot of great things with their portfolio.
That's the way. Well, look, it's a pleasure to have you today. Look, one of the things I know that you're, what separates you guys, you spend about $500,000 a year on AI technology to unearth these locations around Australia. And I know today we're going to talk about real estate and, how you're selecting these locations. But I want to start with something that's a bit more personal, if you don't mind. You've been, quite open with, something quite personal in your personal life right now with some health. Do you want to take us through what's happened over the last 12 months?
Mate, I'm really open about it because I do want many people doing what I did, which is uncover things and get to them quickly, right? And so what I had about 9 weeks ago now was open heart surgery. And for someone, with not as many grays as someone else may have in the older generation, I'm pretty lucky to have firstly solved this, but pretty shocked to get it this early in life.
Amazing.
32 years young, and I got shocked by the news that, hey, look, if you don't get to this, you might not have more than a couple of years at best. And how I uncovered it was through an echogram. I didn't have symptoms because mentally I thought like, hey, I'm just a bigger guy. Maybe running isn't meant to be easy, and maybe walking's not meant to be easy. But really what happened was I went for a life insurance application. I got declined for cover, which was shocking and surprised me. And then they said, go and check this out because of this thing that came up in their tests. And then I realized I was having severely leaking hearts through valve issues, and I was born with it, right? So I think the biggest thing why I come out with a positive view on this is that I couldn't control it. I was born with it. It wasn't that, 2 a.m. kebab that I had at 18 without all my friends going out and about. And it wasn't that, extra packet of Pringles that I'd have on the couch at 8 p.m. It wasn't that. So I was glad on that part. But the main thing was that because it was not in my control, came out with positivity. And I just want to share to everyone, like, it's serious stuff. Go get your echograms, go get your checks. You might be walking around with valve issues that you were born with, that increases the size of your heart. And if you don't get to these things, like, there's serious business, obviously, heart attacks, heart failure, that sort of stuff.
I mean, it's an amazing story. The fact that you've been able to unearth it, and then, as you said, these things can be fixed. It's one thing to find out that you've got these challenges, but it really has given you. I've seen in your personal story, it's given you a new lease on life, Mr. Arjun 2.0.
Yeah, massive new lease on life. I think the biggest thing these things can do for anyone in life is that, for me in particular, I have goals that I set in life, and it was just you walk through them over time, and you have your journey to them, and you take the journey as it comes. Of course, you set micro goals and you try and hit them out of the park, but my level of intensity to hit these high impact goals now is double, triple what it used to be, just because, like the saying, life is short. I got the taste of that when I went through a 10-hour surgery. And speaking of like getting it fixed, one thing I didn't realize was that there was only one, maybe two doctors in this whole country that do this type of procedure. It's called the Ross procedure. And the reason they had to do it this way is because the severity of what I had, the age of what I am, because it's usually commonly picked up in people's 50s and 60s.
Yeah.
So I just think, not only are you lucky to get it fixed, but there's not a lot of people out there that do this. So even luckier that way. But yeah, you're spot on. Second, lease on life. I've got 2.0 coming in, and I'm back with more energy than ever.
That's the way. Look out, world. Arjun's coming. All right. Now, let's start talking about real estate then. So you've built a reputation on finding, investment opportunities that others might not see. Can you explain what buying against the grain means? And then in the context of real estate, why can it be such a successful strategy? Because that's the subject of today, buying against the grain.
Absolutely. So firstly, through our years of learning about data, markets in country, through the things like AI, our spend, our data scientist team, research analysts, and so forth,
Mhm.
and collaborating with your team, right? All the insights that we all come together and do. I've learned that there are about 3 distinct phases of markets.
Yep.
There's early adopter markets where you're getting in early and you apply counter cycle approaches or against the grain approaches.
Mhm.
There are markets that are hotspots.
Mhm.
And then there are markets that I call second winds, where they've gone
Yeah.
through a bit of a dip and they're recovering again.
Yeah.
So those are the 3 core phases. There's obviously 2 phases in between those 3. One is where early adopters transition into hotspot and it's really picking up. And
Mhm.
then one is where the second wind before they go and have their actual second wind, it's a bit rough.
Yeah.
And so against the grain buying is those 2 points. It's like early market
Mhm.
or the second wind's hopefully about to happen and you're jumping in before.
Yeah.
Now, that's what it is, but why is it important? Why is
Mhm.
it important is basically an investor has 2 markets they can approach. You approach with competition, you're in a seller's market.
Yeah.
You approach in lack of competition, you're a buyer's market.
Yeah.
If you approach in competition, though, growth happens.
Mm.
There's never been a world where a seller's market does not create capital growth. The
Yeah.
whole nature of capital growth is 2 people or more fighting for something and willing to pay
Yeah.
more each time. So that's the upside. But the
Mhm.
downside is you're fighting, right? And
Yeah.
then you've got this other side where you're not fighting, but you have to be patient for growth.
Mm. It's interesting. So, right now, I mean, to put that into, recent times, it's like buying in the Perth market, right? We know that there's been strong growth there. You got to pay a premium to get into that market. It really comes down to how early you can be in that competitive market, though. You don't want to be, we often talk about the property clock, and you really want to be buying at 7 o'clock to 9 o'clock on the rise. And people often ask, why don't you buy at 6 o'clock at the bottom of the market? And the answer is that you just don't know how long you'll sit there for.
Yeah, it's a
Yeah.
really good point. So this is why when you have against the grain buying,
Mm-hmm.
you've got to have like 1 or 2 things in mind. The first is you could be a little bit early, and it's important to be patient.
Yeah.
Sometimes people think that by getting in a bit early, oh no, it didn't grow in the last 12 months. I don't know if the city's a good city. Well, maybe you bought really well and
Mm.
like your growth happened in other ways. Like the
Yeah.
growth happened in how aggressively you negotiated, where you wouldn't have had that opportunity. And if you
Mhm.
negotiate quite aggressively, your rental yield lifts as well.
Yeah.
Because all of a sudden you're calculating rental yield on a 500 rent and a 700 asset, but to your delight, you bought it for 650 and it still rents the same, right?
Yeah.
And so I think many people need to factor in you have an opportunity to buy well too.
Mhm.
But yes, when it comes to staying in that phase for too long, that's a risk appetite decision. So
Mm.
there are many people out there who'll go, I'll buy with the grain just because I don't want to wait, right?
Yeah.
I'm impatient. I'm happy to fight in competition. We've got to
Mhm.
pay a little bit more. At least we're going to get 1 to 2% per month growth rate, as you've seen in markets like Perth or regional Queensland, as an example.
Yeah.
But then there are other people that just don't believe in it. It doesn't sit well with them. It's like, I don't want to be there. I get it. I might miss out the next 12 months growth, but I'm in this journey for 20, 30 years. My
Mhm.
retirement's in this journey, and I'd rather have the most of the new markets rather than being in it. So that's where that against the grain buying comes in.
Yeah. It's an interesting thought as well, that when you're trying to buy into these markets, everybody's looking at, can I get a good deal? Can I get a good deal on that property today? And what you're talking about is where that value that you can get in those markets to buy under market value are often in those markets that don't have all that competition, but you might have to wait a little bit longer for that growth. Whereas going into these markets that everybody wants to be in, where you've got to pay a premium, you're going to overpay a little bit to get into that market, but the growth could be faster. The question I'd have for you is, how do you guys identify where those markets are?
Yeah, so I think there's a couple of key indicators, right? I won't go through all the science of it all, but some
Yep.
of the core things here is when markets have been flat for so long, you need change.
Yeah.
Like the mistake many people realize when they're looking at trends or don't realize is they think just because something's been weak, it improves.
Mm.
Is it been weak for 2 years, four
Mm.
years, 6 years, seven? And when's that improvement? In your eyes, it could be, hey, 2 years of weakness must be the third. But what happens if it was the sixth or the seventh? A lot of opportunity cost.
Yeah.
So we don't go into markets for the sake of they're weak, therefore we must buy. Otherwise, we'd be buying all over, say, Tasmania or
Mm.
all over Canberra, right?
Mm.
They're markets that have softened a bit, but we're not buying there because they're not like good long-term markets or anything. We're not buying there because we don't see change.
Yeah.
Once you see immense change, that is when trends start. Now, not so much change where you've waited for years on the price to change, but I'll give you an example. So if we look at the market of Bendigo,
Mhm.
right? Bendigo is an example of against the grain buying. In
Mhm.
2017 to 2019, Bendigo performed extremely well. That
Mhm.
even extended a little bit to 2020 and 21, but then from 21 onwards, the regional Vic and Melbourne actually all saw periods of weakness.
Mhm.
Now, from here, periods of weakness, again, can't be our reason to buy. That's just a
Yeah.
buyer's market with no outlook. We wanted to see change. So a couple of metrics, you can see some change. The first one was vendor discounting.
Mhm.
We saw vendor discounting uplift all throughout and then started to decline. And when that decline of vendor discounting has been happening, that is a start of an event. Then we saw days on market. We look at what we call long-term trends, medium-term trends, and very short-term, like quick monthly updates.
Yeah.
In the long and medium-term trends, long-term, it's still much faster than what it was in 2014, 15, 16, 17. But in the medium term to short term, if we're looking at medium, it's much still longer to sell than it was in 2021 and 22.
Mhm.
And so it's picked up. But then what we do is we look at the short term, month by month, quarter by quarter. And what we can see is it's stabilizing. It's not falling. It isn't like getting way quicker, but the curve is changing. So the
Mm.
key word you're probably noticing me say is change. And
Yeah.
the same thing can be said with sales volumes. Sales volumes were dropping between sort of 22 July all the way to 22 June,
Mhm.
23 June. But then from 23 June all the way to May 24, it's flattened. So
Mm.
it's finding its floor. If you do not see change, you will not see recovery. But if you
Yeah.
start to see change, there are signals that are starting that recovery picture. Those are probably some of the main ones. My personal favorite is actually not those. My personal favorite is rental yield,
Mhm.
because that's an interesting one. I find rental yield really leads the way on many occasions. And
Yeah.
it's not in the way that many people think. They think a high yield. I'm not talking about high, I'm talking about change.
Mm.
So to give you an example, in Bendigo rental yields have demonstrated a lot of change. When I look at their rental yields here, they actually had rental yields about 3.7, and this 3.7 was June of 2022. That rental yield has jumped up to 4.4 as of June 24.
Mm.
So 2 years to jump up almost 1% is massive. Like
Yeah.
if it does that, say, for another 6 to 12 months,
This is one of
suddenly
the things I was also
prices
going to
get.
ask you. How much does the biggest biggest word that's affecting real estate all over the country is supply, lack of supply.
Mm.
That has to be creating that change.
Absolutely. So with supply, it can be looked at one of two ways, right? Is it supply because there's less listings coming to the market, or is it supply because more sales volumes are purchasing, and then as a result, more purchases happening are eating up the current stock?
Mm.
So right now, in terms of a medium term, there is less supply, and long term too. So
Mm.
from a long term, and just using this case study of Bendigo here, supply in 2017 was peak, and it's about, let's say, 1,500, 1,000 houses or listings established, less than what it was in 2023, which, to put it into like context, there's just around 4,000 listings at peak at about 2017-18, and that's about a 25 to 30% reduction when you're going from that point. That's the
Mm.
medium term. It has picked up in a little bit, but remember, picking up or active available listings is also what's needed in a buyer's market, because there's no point entering a buyer's market if you can't buy,
Yeah,
right?
that's right.
If there's no sort of available listings to soak your teeth into, then how can you actually go and say it's a buyer's market when you can't pick up anything? So there still needs to be a lift in listings. Otherwise, there's no second wind happening, because the weakness happened as the listings lifted. And now there's this huge approach of shift in the data points where it's like vacancies are lower, rents are rising, yields are rising pretty quickly, and now people can look at it in different ways. An investor can look at it as going, hey, that's softened, it hasn't picked up as much, it's a good place to buy, it's a negotiating environment, the economy is quite diverse, and I'm getting a tight vacancy, I have stock available to choose from, and rental yields are quite decent. And then you've also got renters who will look at it and go, my rents have going up last 2 or 3 years, prices haven't,
Mm.
and should I consider this? And so this kind of shift can all make movements happen. Look, Bendigo, I'm not saying here that that's the it of everything.
Mm.
I'm also just saying that that's a market demonstrating an against the grain buying opportunity.
Yeah. And Arjun, would you say that much of Victoria would be in that phase at the moment? I mean, we've just been, been talking about the fact that, second wind markets, as you say, we saw very strong growth here, sort of 2020 through 2022, both in Melbourne and in regional Victoria. And we've definitely had that correction. And, outside of our state government down here being incompetent and having these ridiculous land taxes and higher stamp duty and things like that, if you can see past that, there are some huge opportunities here. Our yields have got better. We're definitely in a lull in the market. So do you see, in general terms, Victoria as an appealing place to be investing?
Yeah, and it depends where. I think what you've raised is a really good point. There is this huge blanket approach happening in many parts of Victoria, but maybe let me point out a location where it's the opposite.
Mm-hmm.
Like, hey, there's no change showing that demonstrates a buyer's market is available for good growth in the near future. So that market would be the city of Ballarat,
Mm-hmm.
right? And I want to point that out, not to say that it's not a good long-term market, extremely consistent, very consistent, diverse economy, satellite city to Melbourne, but there isn't any change to show those trends slow. So to give you an example, days on market has rocketed back up and no sign of stabilization, right? Vendor discounting has rocketed to peak levels since 2014. It's actually almost double what it was in 2022. And vendor discounting in the short term has rocketing trend line. These trend lines are like shooting up like an Elon Musk rocket. Like they're not looking, curvy, step by step. They're gone. Days on market that I said on the short term shooting up, it's actually back to 2017 levels, or end 2017, early 2018. If you go to listings are the highest they've ever been on a 10-year basis. So 2014 was the last peak, 2022 became the next peak, and we're now at a new peak. And sales volumes are about the same. So I think it's not a change of demand, because the buying's much the same, but it's the fact that listings have surged and there just is more supply than there is. And that's what led Ballarat to about a 4.5% decline over the last 12 months. Now, there are some green shoots. The green shoots are rental yields have picked up from about 3.3 to about 4%. So that's a big jump. Rents are still rising, although okay, nothing huge. I think the main thing is that's an example of a location where, yes, Victoria has demonstrated some amazing negotiating buying conditions for cities that likely will change in the short to medium, but Ballarat just doesn't seem to sit there in that change in the short term. Even unemployment's jumped up as well from a low in June 23 of 3%, 2.7 back up to 4.5, which isn't high. But I guess that's just helping the watchers and listeners learn great state environment for buying times and an opportunity to negotiate well and go against the grain. But even within that, you have two satellite cities to Melbourne. One is demonstrating trends of something starting to change, and one is just rocketing away the wrong direction.
Yeah.
So I think it's important to look at those trends closely.
Yeah, very interesting. So let's talk about AI and the technology that you use. How have you in recent years been using AI, or at least using AI to sort of weed out or tell you what to focus on in order to achieve some of these great opportunities that you're finding in locations that other people aren't seeing? What outside of the real estate data, what else are you looking at?
Yeah, sure thing. So I think the first thing is when it comes to real estate data, there's many people look at data as of like what it is today. Whereas what we've learned is it's the journey to today that's more important,
Yeah.
right? Trends, you nailed it.
Yeah.
And so a lot of our engine room and a lot of our testing and a lot of data is not going into what the future is simply based on today. It's going into what we call back testing. Like,
Regression
how can
testing.
we
Yeah.
increase the accuracy of our predictive back testing? So, for example, for anyone new to this, going back to 2017, giving it the data from 2017 and prior, building a model for our system to say, what do you reckon is going to happen in 18, 19, 20 before the black swan hits, right? And all of a sudden, models don't give a crap now, right? Or can't tell you anything. But all this 18, 19 to 20, we started multiple years ago with a percentage of accuracy here. And then now we're getting here. And so the investments into constantly improving that percentage of accuracy so that we have greater confidence. And the goal isn't to say, I can tell you every single property in terms of this market and its short term is going to be like this, because even predictions have bandwidths.
Yeah.
And so I hate having bandwidths because it makes me feel uncertain. As in, give you an example. Some of the AI tools will come out and tell you this is -8 to positive 22% capital growth. How helpful is that, Timmy? Like, how helpful is that, right?
That's true.
-8 to positive 22. So we tried those models and we're like, I don't like that. So instead, what we're trying to do is go, can we insert markets into phases,
Mm.
right? If we can use our AI to insert into phases, we can then confidently tell a customer to say, you're early here, too early. You're early here, something's starting to change. Things are starting here, it's ramping.
Yeah.
Super hot.
Yeah.
Was super hot, not as hot as before. It's getting a bit tough again, could be turning around again. And that's that early adopter, hotspot.
Can I ask, Arjun, are you in all of those locations that you're talking about, do you offer your customers an opportunity to buy at each of them because they can choose? Look, you can go into the hot market if you wish to, or are you saying, listen, these are where all the markets are currently sitting in that phase, and this is the phase we're recommending you buy in? What's the trade-off there?
Question. Yeah, so we will show them all phases when they come
Yeah.
on board. So
Yeah,
they'll
right.
get to see all phases as a client and go, wow, I get to know where all the markets are that Investorkit's looking at across all phases.
Wow.
And then when we're constructing a portfolio plan, what's really a big mistake many people make is if they go to Queensland and they say board in Townsville or Rockhampton, now those are great growth markets. But then all of a sudden they see our algorithms and they see more markets in Queensland and hot markets, and they just go, yeah, I'm going to be the mayor of Queensland. Let's go get everything.
Yeah.
That's not a diverse portfolio, because whilst it's a great growth location, you and I both know that markets don't last like that forever.
Yeah.
And the last thing you want is you want 3 years of great equity and then all your portfolios in the lack of equity growth for the next 5 or 6 years. We want our customers to have intentional diversity first, and then market performance is secondary to diversity, because with that, we'll always be able to have something somewhere that's going to do well.
Yeah,
We just
that's a
want that to
really
be at
good point.
different times where possible. So
Yeah.
if you're imagining that visual, someone's looking at it and they're basically going, here's what I have in my portfolio now.
Yeah.
Here's where I'd like to get to. And that gap might be 2 to 3 assets, as an example. And if they've got 2 assets and the gap's 2 to 3, and they've got stuff in Queensland as the 2, we'll tell them that these are the growth markets in Queensland. But together we'll mutually agree in most cases that let's go to maybe this market in that phase in another area, and they all have pros and cons. One belief that we have in Investorkit is there's no such thing as pro, right? You come to an early market, you negotiate well, might be crickets for the next 12 to 24 months. You come to a hot market, you're going to fight with everyone, and the stock's so low, we might take 3 to 6 months to buy it for you versus 1 to 2 months.
Yeah, that's
You
really
come
true.
to a second wind market, it's going to pop off, but they don't pop off for long because they've already had a great 10-year market. So
Yeah.
when they second wind, they do a second wind.
Those
which is
second
that
win
final
ones have
rep.
got to be tied to local income.
That's it.
Yeah. Yeah.
And so that gives you some insights of what we do there.
I think it's a really interesting point which you just made there about the diversification play. Real estate is not a cheap exercise to buy or to sell, and for that reason, this is why we're investors of real estate, and we're not a speculator like we do in shares, right? Because we can chop and change very quickly, very cheaply in the share market. But when you know that you're planning to build a portfolio that you're going to hold for some time, you need to understand that you're not just going to own it for that period of growth that you're targeting today. It is that long-term hold and understanding that your portfolio has got to gel together. So I think it's a really important point for our listeners to jot down.
Yeah, what you mentioned there just reminds me of a customer like Raj and Saji. Recently, like Rajiv and Saji, they made I think it was news.com.au and showcasing this story, which is super inspirational. And they built a near $10 million portfolio. But what was really special about their journey is when they worked with us, we added 6 properties intentionally in different cycles. And that was important because had I look at it, yes, we bought for them example in Brisbane and Adelaide, 2 great growth markets. If they'd bought every asset there, they probably would have done better as a percentage gain based on how strong those markets are. But I can tell you now, 5 years from now, those markets will not be the best performers for that whole 5-year stretch. There will be great performers for the next 1 or 2, maybe 3. But
Yeah.
I don't think for 5 to 10 years you can say that they do another run of what they did before.
No,
And
then as you
therefore they
just mentioned,
diversify.
they'll hit another second wind market.
Yeah,
Like they all do. They will inevitably have that correction, and then they'll have that second boom, but that second boom won't be as strong as the first we've seen.
correct. And that's
Mm.
where splitting them across Victoria, as we did, regional New South Wales, as those two calm down eventually, instead of them sitting tight and going, wow, no more equity pulling for the next 5 years,
Mm.
the other 2 or 3 assets that we bought them in other markets will start it. And then we'll be back again to take equity to start the journey again.
Yeah. Yeah, I want to circle back to a comment you made about yields. So you sort of say yields is a bit of an indicator or a lead indicator on what to expect. And it's funny, a good friend of ours that we're both friends with, Steve Palisi, talking to him a lot about the price and growth of a commercial asset is often tied to the yield, and of course that makes sense. It's tied to the lease. But we're starting to see that more in the investment space now for the people that are sort of targeting that 450 to 650 bracket. That yield is really a good indicator of what price can do as well.
Yeah, definitely. So the concept of price growth, and this is where many people get this wrong with like yield versus growth. It's a horrible way to look at property because once the growth markets become growth, once a growth market has grown a lot, at that point it's a low yield.
Mm,
It used to be a high yielding market,
yeah,
but you trashed on it as a high yielding market, waited till it got to a lower yield, and then you said low yield markets are great growing properties.
yeah,
Hold on a minute.
yeah.
Wouldn't you have wanted to buy it at 5% and then you get the suppression of it going down to 3
That's it. But
rather than you?
that's where your yield grows because your debt doesn't.
That's right. And would you want to come in at 3
Yeah,
and go, I'm in a great long-term market that's had brilliant growth, and you've missed out like 100% of it just because you wanted to wait until you got a low yield, high growth, and your strategy's growth,
yeah,
not yield. No, your strategy should be growth always. But if you can get growth and the area's got good yields, why wouldn't you?
yeah. Now that's good. All right, I've got another question for you, Arjun. What advice would you give to investors who are hesitant to go against popular trends? If they're listening to somebody at the barbecue and they said, "Oh, you've got to be in Townsville, or you've got to be in Rockhampton or Queensland for that matter," and you're saying there's other markets out there that are in an earlier stage of the phase. What sort of advice could you give them to give them confidence to go into those markets?
Yeah, it's a great question. So, firstly, when deciding a market, you want to look at a couple of things. It's easy to talk about 10 locations, but then you look at your budget and it only does 3.
Yeah.
And so, firstly, you want to assess with the budget what are the best options. Because when you're at the barbecue chats, all locations come up. Hey,
Mhm.
did you see Melbourne? And then you're like, that inner market of Melbourne's $1 million. Or maybe you have to now go to the outer part of Melbourne, right? So I think the key is really get budget focused first. Now, once you've got your budget focus, the next thing is you want to look at your own capabilities. And by that, I mean your savings, your income, your borrowing capacity.
Mhm.
If you see that your savings ability is not as strong, but you've got a healthy borrowing capacity for the next one, then your capital growth rates in the short term are extremely important to you. And if that's your first one, even more so. So you may go into a hotspot market like the Rockhampton Townsville to generate that. So this
Yeah.
is you going from budget down to situation. But then if you go, I've got a healthy portfolio, I'm starting to hear all these chats about 5 or 6 different locations, and I don't need the growth immediately. I'd rather have the full run and get to it. My, savings is okay, and I'm not in need for that right now. Like then all of a sudden you should be going against the grain, right? The thing with against the grain is you got to be confident like that. You got to be aware that it's going to be potentially a 6, 12, 18, 24-month change
Mm.
because all trends can pick up change. Like when we see that, but we can't say if that trend changes and growth happens now
Yeah.
or it happens over the next 12 to 24 because trends can change, but they need to intensify,
Mhm.
right? It's like the smoke then turns
Yeah.
into a small like light and then it turns into a fire. You can say there's a fire coming if there's smoke or fire's there if it's smoke, right? But you can't say if that's a full on blaze yet until you get there. And
Yeah.
so I think from that perspective, you just need to be patient on that. And when you're entering these markets, the confidence will come from you going through budget, you going through situation, and then you going through, okay, off the back of that, I want to get the whole cycle, or no, I'd rather take what's left.
Mm. I think what's really interesting about this theme of buying into or buying against the grain right now is that now more than ever is a better time to have confidence to go into that, because we have hit the end of that escalation of interest rates. So as long as you're buying with a yield that you can support today, it can only get better. Whereas if you were buying against the grain 3 years ago, and your yield might have been sitting at 3.5 or 4%, then it would have got much worse, because whilst we've seen some rental increases along the way, our interest rates have escalated significantly.
Yeah, it's a brilliant mention there. What you've touched on is a couple of things. Firstly, interest rates do not just go up; they
Mm.
go up and down.
Yeah,
Rents rarely ever go down.
yeah, that's true.
Like if you go back the last 50 years of data, the curve for rents is in this direction.
Mm.
But if you go back the last 50 years of data, interest rates are like this.
Yeah, that's
And
right.
so if you own an asset in today's point of time and you do know that rates cannot keep going higher, like they will just explode Australia if they just keep going higher, right?
Yeah,
Job ads are falling over, GDP declining, like we're clearly off the peak jobs boom that we had before. And as a result, you can't just keep crushing the economy in that way. Are we having a resilient economy in comparison to the globe with raised interest rates? Absolutely, we are very resilient. But you cannot keep saying that that stays the same all the time if you stay here long enough. So yeah, rents will keep rising, interest rates will eventually come down, and now your yield effect is greater than ever before. And if
Mm.
your yield was today at purchase price 4%, and over the next 5 years it becomes 4.5%, today you seeing 4.5 makes no difference. Interest rates drop 1% or two, and then you're suddenly saying this is a great asset.
Yeah, I think there's a real point just on the difference between gross and net yield. In general, in any market, you need to understand that. We've talked about your Townsvilles of the world, and a lot of people are attracted to that high yield. But then by the time you work out your net and you take into account all of your insurances and things, that net yield is nowhere near as strong as it was when you're
Yeah.
looking at purely on
I
the
think with
gross.
the yields, one more tip to give everyone here is that when you think of that Townsville example, that's a specific example that now you can start applying across all of Victoria in other
Yeah,
ways.
yeah,
Rental compliance,
mm.
safety and standard checks, land tax,
Changes to
and
minimum standards, all those.
yeah, and
Yeah.
increased stamp duty as well for Victoria and South Australia.
Mm.
I started having a viewpoint on this that changed maybe about 18 months ago. And my view here was this. I used to be like, hate that state or hate this state or what a crappy location. Who charges this much for insurance or who charges that much for this? And it was all like, that's horrible, that's horrible. But then about 18 months ago, I thought about it and said, if Victoria can charge it, so can everyone else.
Yeah,
And that freed me up. Mentally, I'm now thinking it's not about what Victoria charges. I'm of the belief every state will charge more as the years go on. And so when everyone else is thinking they're horrible, they're good, I'm thinking everyone's horrible. Some are just horrible today, some will be horrible like
yeah,
later or sooner. And as a result, now you take that out of the equation of your investment making decision and you're focusing it on where are buying opportunities, where are growth opportunities, long term, short term, medium term. Because I can tell you now, if not Vic, everyone else will come along to the party eventually.
yeah. No, I agree. And that comes back to the point that we made earlier, that you're going to hold this asset for a long time. Legislation and things can change all the time. So you need to
Yeah,
be aware that they are different from state to state. So Arjun, I've
absolutely.
got one more question before we wrap things up. I'm seeing a real spike in inquiry on self-managed super funds with property.
Yes.
I think everybody has a different view on what property is suitable for a self-managed super fund. What's it look like for InvestorKit? Does your location change? Does the property type change? What's if you were to paint a perfect picture of a self-managed super fund purchase, what do you look for?
Yeah. So the first thing here in self-managed super fund is that when we're looking for it, we're not as much focused on the short-term growth because you
Mhm.
can't release that equity.
Can't leverage. Yep.
We're thinking of it from a perspective of long-term growth and portfolio fit.
Mm.
So if they imagine themselves, the client imagine themselves with 4 properties as a goal, and they've got 3 already in various locations, we're looking for diversity. And so
Mhm.
diversity comes front of mind. We're also looking at like their appetite to use balances of the funds for repairs, maintenance versus just slow and steady, keep it there on the side. And so we do tend to go for a few more modern properties in SMSF just to
Yep.
feel like it's an asset that can sit there. Also, what we've come to learn is like when you look at SMSF, the interest rates aren't pretty for many loans. Yes, some can be similar to outside, but a lot of them can also be a lot more depending on the bank they're going to. And so many people chase these super high yield assets in SMSF thinking, oh, I don't want my contribution to get stuck into just paying the property. But then you can move the rental yield dial from 4, 5 to even 6. And it doesn't make as much of a difference in SMSF only because it is still negative.
Yeah,
And
and
so
you're
as
likely paying principal and interest as well. So
absolutely,
yeah,
absolutely. So as a result, it's like you're gonna in either yield calculation, you're either gonna actually use a lot of your fund contributions. So
mm,
as a result, why get your 10 markets and cull them down to 2 because you're only after X yield? Really start to be open because you're going to hold this asset for close to 20 to 30 years, if not longer. And so
mm,
that's my big thought on SMSF, which is A, long-term focus, B, look at it from a portfolio fit, C, portfolio fit, C is start looking at it from a perspective of, actually having low maintenance if you can. And
yeah.
then D, the last thing is realize that if you yield constrict, you just blinkers on multiple options. When you have a 20, 30-year journey, your yield will take care of itself over time because rents
Yeah.
will keep rising.
Yeah, I think it's a really good point. The other thing that I would always say is, there's this mindset that a lot of people have that land is best and you need big blocks of land and things like that. But what people may not know about self-managed super funds is whilst you're under a non-recourse borrowing facility, you can't go and do improvements to the property. So certainly no subdivisions, but not even adding second bathrooms or new kitchens or anything. So it's important that when you are looking for something for a self-managed super fund, you know what the laws are around what you can and can't do, because typically those larger blocks may not be any use to you until you sell it.
Absolutely. And I've gone into the details of reviewing land as well. Like I'm surprised by how many people think that land size and or available land simply define an investment's prospectus of like if it's good or not. Like if land size was the driver, why isn't every investor going into the outback of Australia and buying 10 to 20,000 square meter blocks?
Mm,
Therefore, they should grow the most. They should be the most valuable gems in this country. And why are people paying millions for 180 square meter terraces in the inner west of Sydney?
yeah, that's
So
right.
the thing is, land value is what someone's prepared to pay for it.
Mm,
They're not, whether that's low maintenance, double story terraces in the inner parts of the city, or whether that's suburban blocks. You can even come out to, parts of northwest of Sydney, suburbs like Box Hill, where the land is between 250 to 400 square meters and people pay over $1 million 50 kilometers out from the CBD.
mhm.
So really, it's what someone's able and willing to pay for it. If sales volumes in an area showcase low levels of land and they're high, all that simply means is deals are being met at high volume in low land size, therefore of importance to someone, right?
Yeah.
And so I think people need to start looking at that differently. And even just with that, Australia's average land size used to be 7 to 800 in the 1970s.
Mm,
That's now dropped to between 375 to 425, depending on the different cities.
mm,
So believe it or not, like you may not have many investment choices decades from now that don't have, that actually even have big land. They're all
yeah.
going to be smaller land properties in decades from now.
Yeah, I'd agree. And I think the kids would probably prefer to go to the local park and kick the footy than the backyard most of the time now anyway.
Yeah, absolutely. And if you're born in New Zealand like me and you're playing with a rugby ball in the backyard, you're going through fences and stuff. It's not fun. It hurts, right?
That's
So
it.
you don't want a cricket ball to keep flying over someone's neighbor when we're hitting it for 6 and someone's roof and glass is gone. So they're fun memories. Don't get me wrong, but you don't want to be on the rough side of an Indian dad. So that definitely not
That's it.
fun.
Very good. All right, mate. Well, as always, it's been an absolute pleasure having you. Love talking real estate with you. If anybody wants to talk real estate with you themselves and have a chat with your award-winning team, what's the best way to get in contact with you?
Two things for me. So one is I post a lot of content on LinkedIn. So if you
Mhm.
search my name, Arjun Paliwal, please do connect with me. Would love to chat. Secondly is if you connect on investorkit.com.au. Our team is award-winning, as you mentioned, and we'd be here to help.
Yeah. I urge everybody, reach out. You won't be disappointed with what the team will take you through. It'll open your eyes up to a lot of different ways to think about real estate that you may not have considered in the past. Arjun Paliwal, always a pleasure. Let's do this again soon.
Thank you, Tim. Cheers.
Thanks, mate.